Hello there, and welcome to this live panel event hosted at the Nasdaq studios in Times Square. My name is Richard Johnson from Greenwich Associates. I'm going to be the moderator for this event. Today's topic is trading the auctions, and we're going to be talking about the exchange-operated auctions that set the trading day off at the beginning and the end of the day. You're probably most familiar with them because that's when we have the opening bell ceremonies and the closing bell ceremonies here at the studio and also at the New York Stock Exchange downtown. There's a lot more that goes on behind the scenes to these opens, and that's something we're going to be talking about today. A little bit about the format of this event. We're live streaming now on Facebook Live, and we're also conducting a webinar for previously registered attendees. The registered attendees will be able to ask questions throughout the webinar, and also at the end we'll have some time for that. So please, if you are registered, just enter a question in the chat box, and we'll try and get to it as soon as we can. We have a great panel today to discuss the opening and closing crosses. We have representatives from Nasdaq, representatives from the buy-side investment management community, and from the sell-side brokerage community. So we should be getting a lot of different perspectives and have a great panel. So first of all, let's go and have our panelists introduce themselves, starting with Joe here on my left.
Thank you very much, Richard. Hi, my name is Joe Wald. I'm the CEO of Clearpool Group. Clearpool is an agency, institutional broker, as well as a technology developer.
Thank you, Richard. John Latino. I'm a senior trader at ZPR Investment Management. Formerly did 7 years at Oppenheimer Funds and Jacobs Levy.
Ed Coughlin. I manage the Nasdaq trade desk and, in addition, involved with market structure initiatives here at the exchange.
Oliver Albers. I head up sales for our Global Information Services Group.
Great. So let's get to the topic. Greenwich Associates recently published some research on trading the auctions. We did some qualitative research where we interviewed a number of buy-side and sell-side participants about what they thought around the auctions, and we also did some quantitative research analyzing the data feeds that the exchange provide. A lot of interesting information came out of that report. You can get it from the Greenwich Associates website, greenwich.com, or from nasdaq.com. One of the interesting things, I think, was that we've seen over the last 6 years, volume in the open and closing auctions has increased from 4.7% to 6.75%. Now, that may not sound very much, but it's actually a 44% increase, which is pretty significant. So first question for the panel here, why do you think why are the auctions such an important part of the trading day, and what do traders need to know about them?
I guess I'd start there. Probably the theme of passive investing. Passive investing being benchmarked to the close. Liquidity during the day. We all know that trading is now broken down into, on average, I think 175 shares a piece during the day. So traders, investors, the whole investment community is looking for better liquidity points during the day in which they can get larger size off and in kind of what I would call an efficient, price transparent way. At least that's the big theme I think of in terms of the crosses having grown.
Mm-hmm. Any other comments?
Agreed. Passive and the auctions being a liquidity event.
Right. Okay. So when you carry on, Ed, you manage the trading desk here at Nasdaq.
Sure.
Can you explain to everyone how the auctions work at Nasdaq? I know they're a bit different between exchanges, but
Sure.
tell us about the Nasdaq one.
Well, an auction in itself is just, it's a collection of buyers and sellers. So every day we run an open auction and we run a closing cross. In addition, we have crosses that are during the day for regulatory halts, news and balance halts. And all of those crosses are designed pretty much in the same fashion. One of the biggest beliefs is promoting what I would call price transparency and the ability to interact in the auctions so that we not only have what I would call an automated time scale in which machines can react to the auctions, but we also have a human scale in which we disseminate information broadly. The information we disseminate is the net order imbalance information. And in that information, we disseminate every 5 seconds, the symbol, side, and price of the auction that would go off at that moment in time. In addition, any imbalance is there. And what we hope to do by doing that is get the investor community out there that can offset these imbalances in the most efficient way and transparent. And backing up the opening, we start to disseminate information at 9:28 in the morning. And for 2 minutes up until 9:30, every 5 seconds, that information is continuously updated. And then at the close, we do a similar process, but beginning at 3:50 in the afternoon, we just start disseminating that same information in which symbol, side, shares, where the auction would go off at this moment in time, where the stock is at this moment in time, and then what we call a FAR price, or in essence, where the auction would go off if we only look at our closing interest in there. There's a lot of confidence in that process. There's a lot of rigor. Nasdaq backs that process up, several which ways to ensure that we can have a cross every day in those securities.
Right. So, I mean, a lot of people, when they think of auctions, they think of people standing around shouting and screaming at each other. We've moved beyond that now, and it's all electronic. And you're kind of trying to create the traditional auction by publishing the data so people know what's going on, and instead of waving their hands, they're entering orders electronically, right?
Exactly. So now you don't have to physically be there. I mean, the exchange space is fully electronic now. That information is disseminated widely and broadly. People across the world are trading at our openings. People across the world are trading at our closes. Orders, we start accepting orders at 4 a.m. in the morning. So if you want, for example, today, the closing price of the security, you can put your order, if you're in Hong Kong and you want to go to bed, put your order on our auction and it's going to get executed.
Right. Now, one of the things that came out of our research was that we asked a number of traders on the buy and sell side, what are the most important features of an auction? And the top answer was execution at the official auction price. John, you're a buy-side trader. You trade for investment managers, money managers. Do you agree with that?
I agree. I mean, it's an important part. For index funds, it's a critical part. And for most of the quantitative funds I've traded for, they're referenced or benchmarked to an index, so it's certainly important, but not critical.
What are the other features that you appreciate from an auction?
Liquidity.
Liquidity.
Right.
Yeah, so like Ed was saying, you tend to get more, if you trade an order in the market, in the continuous market, you're maybe only getting a couple hundred shares, but you can execute maybe 5,000 or 10,000 shares.
Correct.
So that's more of a vehicle for institutional investors.
And benchmark as a trader, it's going to affect your strategies.
Right. So another interesting thing coming out of our research was that 83% of traders use an algo trading algorithm to execute in the closing auction. So I want to turn this to Joe. Your company builds algos for the sell side and also for the buy side, in effect. Can you tell us a little bit, kind of broadly, what is an algorithm, how does it work, and maybe speak a little bit more about your, how you trade in the auction round with an algo?
Sure, Richard. Yes, and electronic trading, algorithmic trading, as the close has become, or the open auction strategy has become a much more kind of important part of price discovery and of liquidity formation. The algorithms have been designed to take advantage of using the close, and there are a lot of different mechanisms with respect to auctions. All the different markets have different nuances and different order types and different behaviors in the way that they process that information. And having an algorithm that understands how each of those work specifically is critical to being able to maximize the opportunity to really get a more effective and more efficient price. Typically, all algorithms have the opportunity to be able to leverage the close. So whether it's a bespoke algorithm or a specific algorithm that's designed to target the closing price, or whether it's a passive algorithm like a VWAP or a TWAP, those algorithms have the ability to participate in the close. And whether you choose to do that or not is really up to the trader. But the key nuances and the keys to being able to do that are the balance between leveraging what's happening in the continuous market while having real algorithmic technology that kind of determines kind of where the close is going to be. So that type of behavior and analytics, basically understanding and predicting in terms of where the volume is going to be, and then having the control over the urgency of how much do you trade in the continuous market versus how much do you leave on the close, are critical to being able to kind of distill the best the information that's coming out and ultimately get the best execution quality.
Right. So clients who trade with you, they often want to get the closing price or better even. So you're looking at a number of different analytics. Can you talk a bit more about what kind of data you're looking at?
Yeah, the key is processing the data that's provided by the exchanges, as well as our own analytics that are really focused on forecasting the volume in a very dynamic mechanism. So basically looking at what's happening in the continuous market, assessing what's happening from the trading and the executions that you get back then, overlaying that with the information that you're getting from the exchanges regarding the auction, and then being able to uniquely participate in those, as you have the information coming to you. So it's a very dynamic process that involves some real quantitative logic behind it, but ultimately it also rests on the trader understanding, the name that they're in, the price action that's happened, and the urgency level at which they want to participate, whether that's, more in the continuous and less on the auction, or, more on the auction and less in the continuous, and the velocity at which they do that really determines how, the execution is going to present itself at the end.
Right. So you mentioned data products that you're taking in. You're taking from all the exchanges. Not all exchanges have auctions, but all exchanges that list stocks do have auctions. Oliver, that's kind of your remit over here at Nasdaq. You're in charge of the data products around that. Can you tell us a bit about the kind of information you're giving to customers?
Yeah, exactly. In Global Information Services, we're in charge of making sure the markets are as transparent and fair and as efficient as possible. So specific to the opening and closing auctions, as Ed mentioned, we have a data point called the Net Order Imbalance Indicator, and that's part of our Nasdaq Total View offering. Nasdaq Total View is really kind of the one feed that all traders can use to access the markets officially, provides them everything they need, hence Total View.
Yeah.
And so we provide that both on a direct data feed to a lot of market participants, and we also partner with a lot of market data vendors. All the major market data vendors take the Net Order Imbalance Indicator and obviously display that to professional audiences to help offset the imbalance and provide transparency going into the open and close. We've done a lot of work around that over the years. Initially when we launched this, there wasn't another data point like the Net Order Imbalance Indicator. Nasdaq was the real innovator here. Mm-hmm. And so a lot of the market data vendors just kind of fit it within their existing screens, and it was kind of hard to read. And over the past 10 years, we've been in active dialogue with the market data vendors to make sure that they're putting the data in a format that's very easy to use and readable and actionable. And as a result of that, we even offer it on our own website. So really anyone with a web browser and an internet connection can access our imbalance data in our Total View product by coming to our website. They can also go to their market data vendors. Even retail audiences have access to this information via the retail online broker, likes of Ameritrade, Charles Schwab, E-Trade, all carry Total View. So it's really something we're quite proud of, in that this auction imbalance information and really all the depth information that comes on Total View is broadly available both to the professional audience as well as to the retail audience, and that's part of the reason why our crosses are so efficient. Yeah,
and let me echo something that Joe said with regards to the continuous market. And Nasdaq, no doubt, promotes the continuous market because it trades. It's part of the cross. And one of the beauties of the net order imbalance information is that it is telling you in real time, every 5 seconds, where that auction is going to occur. So at 9:28 in the morning, we're telling you, we have this symbol, these many shares, and this is where this auction is going to occur. 5 seconds later, that same information is republished based upon movement in the continuous. So it's, whether it's be traders, investors, they can access the information, they can look at it, and they can use that in their trading strategies to say, okay, this looks this price. Okay, I want to do this, I want to do that, I want to offset that, I want to participate in that. And it promotes a fairness and a transparency where there's a deterministic look at what those auctions are going to do. And widely speaking, we want as many people as possible looking at this information, because quite truthfully, as many people as you can get in your auction creates the best, most efficient price discovery process. Right.
So like I say, you mentioned, especially when you're trading around the close, when the continuous market is still running and there's orders in the auction, many of those orders will have limits on it, and the goal of the cross is to maximize the number of shares crossed, right? Basically get the biggest auction you can. So,
well, I would tell you the goal of the cross is to get the best price possible.
Right.
Okay, so there's shares and then there's best price, because obviously you can have a price outside a range and get more shares to participate. The goal is first to get the best price possible and to minimize the impact. And when I look at that, I say at 9:28 when we publish imbalance information, what is the movement in the price between 9:28 and 9:30 when that auction goes off? And then I look at the close and I say, what is the impact of the price between 3:50 and 4 o'clock? Mm-hmm. And what we're trying to do is attract as many orders as possible to minimize that price slippage between those time frames.
Yeah, and one of the things we studied in the report was we looked at the quality of the Nasdaq feed, and you're giving out something called an indicative price and an indicative size, which is basically how many shares you think are going to cross and at what price. And we did find that it was very close to what actually occurred in the market at the time. So we certainly saw in our research that there was a high degree of accuracy in the data feeds you provided.
Yeah, and we think that's a key differentiator in our crossing process, in that the way we've designed it, the imbalance indicator is far more indicative of what the auction is actually going to do in terms of the size and the price you're going to get than competitive offerings out there.
Right. Now, so just to get a little bit into details here, you do we mentioned the indicative price. There's also the indicative size, how big it's going to be, and another thing we looked at, what you publish, is the imbalance. One of the things that came out of our research was that nearly half of the people we spoke to thought that knowing an imbalance is very important, but also knowing the intensity of an imbalance is important. John, can you maybe speak to that, explain what that is to our audience?
Well, I guess the size of the imbalance going in, and the ADV, and those all come into play.
Right. And is that an important thing? What do you think about that, Joe? Is that something you look at?
It's definitely something we look at. I think it's important to also note that the intensity of the imbalance is what's been displayed, but there's a lot of order flow behind that sits on traders' blotters that has to be anticipated, and I think that's really the key. Is there are lots of tools, and each market does it a little bit differently, but understanding trading, what's on the book is not all that there is to trade. Mm-hmm. You have to anticipate what's behind that and the order flow behind that to really effectively try to adjust your trading strategy. So it is important to have those tools, and there are different levels of volatility around the efficacy of each of the auctions and each of the different markets. But from a trader's perspective and building technology that has to work for traders, anticipating what's not on the book is as important as reading the data as well. So there are a lot of factors that go into how to design a strategy that ultimately is as effective as possible, and utilizing the tools that are brought to bear from Nasdaq and other market data providers.
And from an exchange perspective as well, obviously, we want to offset any large imbalances and make sure that our cross is operating as efficiently as possible. And one of the other things that we did with the launch of the closing cross in 2003 is we created another product called the Net Order Imbalance Snapshot. And what happens there is, leading into the open and close, if we have certain securities with significant enough imbalance, we actually distribute that on the Net Order Imbalance Snapshot feed, and it goes to the newswires. And so it's an additional place of dissemination to basically attract additional offsetting interest. And we found that's very valuable, and also very appropriate for our IPOs. That information is going across the newswires, given the broader interest in IPOs.
And to the point that you bring up about traders themselves, they may or may not be participating in an opening. And what that information gives you is a snapshot or a potential peek into what's going to happen 2 minutes from now or 10 minutes from now. And if one of Joe's traders or one of his clients has an order on his book and he was wanting to sell stock XYZ up 20 cents and the auction says it's going to be up 25 cents, that's going to encourage Joe's trader to say, you know what, I can do better than that price, and that's going to come in. And that creates price competition. And then I hope, one of your clients comes in and says, well, I can even do better than Joe's clients, and comes in. And that kind of creates that price competition to get the best price for the auction. And being transparent, delivering that information on a consistent basis, you know what to look for. 928.05, 928.10, every 5 seconds you're getting it. And your traders are attuned. I mean, I own their eyeballs for 2 minutes before the opening and in 10 minutes before the end of the day. And it's a great opportunity for sell-side firms to interact with their clients. They see what's going on, in the market at that moment in time, and it really promotes a great process.
Mm-hmm. So if you're publishing the imbalances, and let's take an example here. Let's say that there's a really big sell imbalance, which means there's 200,000 shares more on the sell side than on the buy side. So on the one hand, you could think, oh, well, that's going to push the price down and maybe cause a bit of volatility in the market, which traders don't want. So you're sending out alerts to everyone in the market across the newswires saying there's a sell imbalance here, hopefully draw in more buyers to take advantage of it and neutralize that imbalance and kind of dampen the volatility. Is that right?
Yeah, that's definitely how it works. And let's look at an illustration. $20 stock. In your example, there's 200,000 for sale.
Yeah.
We would be telling the world, for example, let's use for illustration's sake, it's looking 1950. So in essence, it's looking down 50 cents. And what I would hope to have happen at that point in time is your client comes in and says, you know what? I'll pay 1960. Your client comes in, I'll pay 1975. And then others in the marketplace start to come in and say, I'll buy this, I'll sell. And then now all of a sudden you have what the marketplace is designed to do. It's designed to react to that information. If the stock needed to open at 1950 and there were no more buyers, that's a fair and equilibrium price for that stock at that moment in time.
Great. So I want to come back to something we touched on at the beginning, which was the shift to ETFs and passive flow. It's something you probably read about a lot in the press. A lot of, obviously there's been a big boom in ETFs. Robo-advisors are coming out, attracting a lot of funds into them. They invest primarily in ETFs. The performance of these types of index funds have beaten a lot of the actively managed funds. And I've got some Greenwich data here. So in 2003, passive represented 12% of global institutional AUM. And in 2015, it was 22%, and it's going to be going up to 26% in 2020. So let's talk about that a bit more, because obviously that's a big trend. It's something that the behaviors of your average investor in their 401k is impacting that, possibly leading to this increase in the ADV at the close. Can you kind of explain a bit more about why that's so important for a passive investor? Perhaps, John, you can tackle that one.
Well, ETFs are the close, and they're bench. So to that extent, and I guess if there's arbitrage that'll keep those in line. If you get
so the price, the NAV is based off the closing price. Is that it? Okay.
Right. So that's how they're designed. So, but then you'll have illiquid stocks that you don't want to do any. You don't want them to behave in a crazy manner. So a closing auction would bring those back in line.
Right. And what about the passive funds? Why is it so important to these guys to get the closing price?
So passive fund, again, if they are the close, they're going to have to participate unless it's, again, a large ADV. They don't want to impact the close.
Right.
If it's a low enough ADV, they'll submit to the close.
Yeah.
If it's so again, we're quantitative funds that are benchmarked to an index, but so the close is important, but we want the best price, so we'll participate. But if it gets out of hand, we'll opportunistically trade it.
Yeah. Joe, you want to jump in on that?
Just say there's a rationale though behind the move from passive to active, which has kind of run parallel with a very low volatility market environment. So I wouldn't rule active management out as volatility comes back into the marketplace. But clearly, from a passive perspective, if you're benchmarked to the close, the auction is a critical component of your trading, which again makes it more important to be able to have some kind of advantages around. Can you do better? Is there opportunity to be more effective than just an auction? Which maybe there is, maybe there isn't. But the data that we've seen is that having a balanced approach to that is kind of an effective way, at least to hedge whether your overall value is going to be in that closing price.
Right. Because the passive funds, they want to replicate the index, and the index prices are based off the closing price,
right,
which is determined by the auctions. So if they get a worse price than that, they're going to underperform the index, which is not very good for them.
No.
Some of them, as I think you were hinting at there, John, try and beat it, where they try and get a better price to kind of outperform the index a little bit. But obviously that takes on more risk. We're going to be wrapping up in like 5 or 10 minutes from here, so if there's any audience questions for people on the webinar, please shoot them over now and I'll start working those in. One thing that someone brought up to me recently is that, in fact, relative to other countries, for example in Europe, auctions here are a smaller part of the trading day. In some European markets, they can be up to 10%. Do you think we'll ever get to that point in the US?
It's hard to imagine that we will. If you have the diversity of markets that we have here, which is great from a competition standpoint, each one of those markets is going to want to have something unique about them, and the close as it gets more important, or any of the auctions as they get more important, that's going to be something where they look to differentiate themselves. So it's doubtful that we go to that style of European close. And from our perspective, the key is understanding the microstructure nuances of each and every one of these auctions so that we can ultimately benefit our clients and help them achieve their trading objective.
I guess I would say, and I agree, we probably won't get to the extent of the participation in Europe, but there is no doubt that the closes are growing, the openings are growing. Even just take a look at trading impact during the day. So if you said I have 50,000 shares to buy, and as Joe points out, what's appropriate to trade in the continuous, what's appropriate to trade in the close. If I, at this moment in time, it's, here it is, 11:25, went to buy 50,000 shares, I potentially have more market impact than participating at the close, where the promoting of that information, the transparency, and gathering buyers and sellers together at one time, your impact would tend to be less. And as passive investing continues to grow, naturally closes are going to continue to grow because they're benchmarked to the close. So I don't know what the tipping point is. I don't think we'll get to Europe because we have a very robust continuous market and we want to keep it that way. But I do believe auctions will grow.
So I've got a question from the audience here. If auctions are so good at price discovery, why don't you do more of them? So are you thinking about doing kind of intraday auctions? Is that something on the table?
Yes, we are constantly exploring. Now, it's been tried and done, many times over, but not to say, that we use the term "back to the future" sometimes. that we wouldn't look at doing that. And I would say, in the coming years, that is a horizon that there certainly is possibility for auctions.
Okay, I got another question here. Is there any latency in receiving Nasdaq total view data via web browsers and other feeds?
Yeah, well, I think there's inherent latency with distributing anything over an internet connection via Comcast versus connectivity via in one of our data centers or even via a Bloomberg terminal. So yes, there's always geographic latency as well. In the event that someone's getting a broadband connection in California is probably going to be a little bit more delayed than someone accessing it in New Jersey, for example. So yeah, it's just simple physics there.
Right. Now you kind of guys touched a little bit on IPOs, and issuers have a choice of where to list their stock. Do they get very involved when they're talking to you guys about how the auction process works? Is that a factor for them that they look at?
Yeah, so the IPO auctioneer is just sitting just across the room from us here. So, Nasdaq's invoked, an IPO execution officer. So they are definitely, comparing models. Nasdaq's IPO execution process, with the officer, has a human controlling that button now. That's working with the underwriter, that's talking to the investors, and making sure that IPO goes off without a hitch, in all instances.
Right. So is there a question for our traders here, I think for Joe and John. Are there any features you would like to see in the closing cross, anything that would make you use them more? Maybe give some product tips to the Nasdaq guys here.
I think transparency is all good. I think you're doing a pretty good job with that. What do you think, Joe?
From our perspective, we really are looking at what the exchanges make available to us and then doing our quantitative analysis on how those are going to impact the ultimate execution price. So, whether it's adding different order types, moving the close up, allowing cancels to happen, there's a number of different things that could happen. But from our perspective, it's whatever the exchanges come out, it's our job to be the domain expert on that microstructure and the impact of it, and then implement it accordingly to be able to suit the needs of our clients and ultimately have a more effective trading strategy.
Well, and from an exchange perspective on the information side of things, this information is already very pervasive in the industry. I think our focus is more on sort of improving the display of that information and making sure it's easier for buy-side and sell-side traders to use, as well as we're always in dialogue with our clients in terms of what other data points would you like to see, what could help you interact with our auctions more efficiently, and so those discussions are always ongoing.
I got a question from the audience here on the webinar. It's a little bit technical, so maybe explain it as you answer it. In the total view feed, there is disseminated a near price and a far price in the imbalanced information. What is the difference, and why would it be useful?
Okay, sure. So the near price is, in essence, you can think of it as where that auction would go off at that moment in time. The near price includes, for the opening, market on open orders, limit on open orders, imbalance only orders, and then the continuous market. And what's important in the distinction between the near and the far price is that the near price contains the continuous market. And when I talk about the continuous market, I'm talking about orders that are live and executable prior to the opening. In the case of the FAR price makes, let's say, what I would call a worst case assumption that the orders that were available to trade between 9:28 and 9:30 are either canceled, no longer available, or repriced. So that kind of gives you this, the near price is where the auction is going to go, and the FAR price is kind of worst case where the auction will go if there's no continuous market orders. And that kind of gives you two views at a look at the auction. And those are the key in terms of transparency when your guys or traders are looking at it. Where is that near price? Can I better that near price? Do I want to participate at that price? Hopefully that answers the participant's question.
Okay, great. Another question here. Let's see. Can you explain the difference between how are we calculating the intensity of the imbalance? I could tackle that, or maybe you guys want to talk. It's something we mentioned earlier. So that was something we did in our research. Let me take that then, which is essentially the intensity of the imbalance is saying that if the match shares is say 50,000 and there's an imbalance of 50,000, then it's a 1-to-1 ratio. Not such a big deal perhaps, but if the match shares is 50,000 and the imbalance is 200,000, then that could cause some impact on the price. So that's going to be more important for traders to look at. All right. Any other questions coming from the audience? I'm going to wrap it up in a minute if we don't have anything. Okay, final comments for you, Joe. What do you think about kind of the future of open and closing auctions?
I think the future of open and closing auctions really do mirror the future of electronic trading, which is the more transparency and the more control the end investor has over the decision-making process from an execution standpoint, the better and the healthier the markets are going to be, and the more efficient investing in the markets is going to be.
Right. Any other comments, John?
Well, yeah, I think it's I think it's going to increase in volume, and I think understanding the auction process and I think algos into the auction that utilize all that is important.
Okay, actually I've got another question just came in for the Nasdaq guys here. What is the percent of orders that come in MOC, which means market on close, versus limit on close for the auctions? Do you have that data off the top of your head there?
It varies stock to stock.
Yeah.
I mean, quite truthfully, I don't think there's one number that would say it. It is, there's no number that I could repeat that has, I would say, validity.
Right. What about you, Joe? I mean, your algos are sending in orders all the time. Do you send market on close orders or limit on close orders?
It really is up to the discretion of the trader, so we have a host of the wide variety as well.
Right. Great.
Yeah.
Okay. We have no more questions from the audience. I think we covered all the topics we wanted to. So with that, we'll wrap it up. I'd like to thank our panelists very much for participating in this. Thanks to everyone on the webinar. We are doing a brief survey afterwards if you're on the webinar. So fill that out, and if you have any questions, you can reach out to myself or any of the guys on the panel here. Thanks very much.
Thank you.